another weekly general update for the 5th and 6th of November. And after the very powerful run that we'd had during October, the last week did settle down just a little bit more. So not quite as much up and down in the market. Now, before I get started, just a reminder, this is general advice only. Now, the action for the week, the S&P finished 2.3% lower on the week. There was some further downside which was recovered in the last couple of days, but considering we had such a powerful run in October, seeing a bit of consolidation was pretty much expected, and we may see a bit more of that during the remainder of November. Now, the sentiment readings that I look at overseas, which are mainly US based, and there's a lot of them. A lot of them have moved a bit more towards neutral to positive. A lot of these sentiment indicators are turning a bit more bullish now, which is from a contrarian point of view. We want to be perhaps looking for some downside at some stage. That's the way it works. So continuing to watch those fairly closely. In the next few days, it really could go either way, and as I wrote in the written alerts this weekend, I'm really looking for a move either above or below the recent short-term range to give me an idea of where we might go in the very short term. So we'll have a look at the chart on that in a minute. But just looking at everything as a whole, I've still got some concern that we may see a larger downside move in the next few weeks. I still think we'll see a rally into Christmas at some stage, but there's still plenty of scope for us to see another sharp move to the downside, and there's certainly enough fundamental reasons in Europe for that to occur. Now, the ASX closed down about 70 points on the week, which was pretty mild compared to a lot of moves that we've seen over the last 3 or 4 months. The Aussie dollar surged back again, sitting around about 104 at the moment. So that's been a very strong move back up from the mid-90s. Gold closed $10 lower on the week, and the medium-term direction for me is definitely higher, but it will be volatile, and I'm expecting that we will move back towards the $1,900, $2,000 mark between now and Christmas. I think is quite likely. Silver was a little bit lower on the week, down about $1, and copper was also marginally lower as well. Now, just a quick look at strategy before I get to the charts. So with respect to stocks, again, it's still the same. We're looking to buy the dips, in fact, to buy over sold extremes on quality stocks. We are going into a seasonally stronger period, both for stocks in general and particularly for gold. But you want to stick with quality stocks at this stage because they're the ones that will hold up better in a panic sell-off and will rebound more quickly. Emphasis still on gold producers, of course, and there was some more of that in the written weekend alerts. So I think we've identified the pick of the Australian gold producers. But I'm also looking to increase shorting to companies that have got excessive exposure to European debt, and we've got one of those on board now, and I'm looking to add another couple because I think the odds of that problem becoming a lot worse in Europe, and I think we're going to see more situations like we saw with MF Global in the last week. In fact, towards the end of last week, there was another American financial institution called Jefferies, which there's a lot of speculation is also in trouble. So to think that MF Global is the only company with exposure to European debt is probably wishing for a bit too much. So I think we're going to see more in that regard. And just finally, I'll be basically outlining the metals and index trading that we've been working on now for the last couple of months. It's an almost mechanical approach. It's a very straightforward approach, but the short-term trading that we've been doing has been yielding excellent results. So for those looking for cash flow, this really is starting to look the goods now. And of course, the advantages are that there's zero brokerage, and you can use extremely low risk per trades. So it's a really appealing looking system. but more about that at the monthly session during the week. Now let's look at the S&P first of all on a monthly chart. So you can see we had a very substantial dip and recovery in August. We then got a lot of follow through on that decline in September, and then a huge October. Initially down a little bit lower in October, and then really surged from the 4th upwards. And we're only a week into November at this stage, but a little bit of time out, a little bit of respite from the volatility. Now this is the S&P, and over the last couple of sessions I have drawn some comparisons to the pattern that's unfolding now with the pattern that we saw prior to the GFC, and there's certainly enough triggers out there for us to have another kind of market situation like we had in 2008. Now I'm not saying that's going to happen, but it's just there's some strong similarities in terms of the pattern. You see here in 2007 and into the middle part of 2008 we got a series of lower highs and lower lows. We had the green 150-day really turnover that occurred around about January of 2008, and then the market, once it got underneath that green moving average, it then started to rally back up to it and couldn't get through it. And if there's a lot of similarity in the pattern, and if you wanted to draw a comparison of where we are now, then it's probably looking somewhere around about this area here, where I've got this this little marker. Now that may not happen, we may end up going higher, but yeah, there are some similarities there. So in the short term, I'm looking for 1301 as the maximum retracement level of this move down. You can see here we've got a bit of an overhead resistance line coming in, which at the moment is sitting at about 1320. But for me, just over 1301 is the maximum retracement level. If the price starts closing above that, then I'd be really looking at us having entered a new bull market, and be looking for higher prices. And that may well occur if the printing presses really get cranked up in a fairly obvious sort of way. Now in the short term, I'm not sure whether we've now got 3 waves to the downside. So we've completed 1, this is 2, and we've got a 3rd wave to the downside before we then move up into the end of the year. And the sign that that would be the case would be a close below the low of the 1st of November, which is 1215. So a close on the S&P below 1215 I think would indicate perhaps a run down to 1183 or possibly even 1158. So that's one eventuality. The other possibility is that we're still in the progress of 5 waves to the upside. So here's the first one, there's 2, there's 3, there's 4, and this is the 5th one heading up towards 1301 before we then get a bigger picture correction to the downside. And the indication that that is the course of or the direction of the market would be a close above 1264. So I'm really looking for a move below the low of the 1st of November or above the high of the 3rd of November to indicate where to in the next few weeks. Let's just have a look at the volatility index, the VIX index, just to give us an idea of how much fear and apprehension is still in the market. And you can see this key line in the sand, which is 30%. You can see that it doesn't tend to spend a lot of time just going sideways above 30%. Yes, we spent quite a bit of time above 30% in 2008 and going through into 2009, but most of that, the VIX index was either rising parabolically or it was actually in decline. I can't remember seeing, and here's another little section here in 2010, I can't ever remember seeing the volatility index just basically go sideways like this at an elevated level. That's not normally how things work. We've had a couple of days underneath, but most of the time it's been above 30. That's indicating that there's still a lot of fear out there, and a lot of the major traders are still looking for protection. Now let's have a look at the Aussie market. So the ASX 200, you can see we had a very strong downtrending channel in play from April until October, and just in the last couple of weeks we've broken out of that downtrending channel, so that downtrend is temporarily finished, and we're now just tracking sideways. You can see the RSI sitting just above 50 at the moment, so it's likely that we'll just continue to track sideways and follow along with the US market. So there's not really a lot that we can determine out of that, other than the index value is still below the 150-day moving average, which is still tracking downwards. We've got the red 50-day has now leveled out, so that's a sign that we may have based out, but really we need more information at this stage. Now let's have a look at gold. So here's the gold chart. You can see, pan back, we've had a major move since 2008. We've got run from just under 700. We've run as high as 1900. The price got really overcooked. Way up there, it's pulled back exactly to the 150-day, which is what's been containing it. It bounced off that twice and now has moved up to form a new high, and we've still got the red 50-day above the 150. The price is now broken back above that, so for me, overwhelming probability that gold is heading higher, which is what you would expect. Silver is going to track along for a period, and at some point will really start to outperform gold, because it's such a smaller market that once people really start to jump into precious metals, the silver price will respond much more strongly. So I can see a lot more upside in silver over time. And finally, just looking at the Small Ordinaries Index in the Australian market, you can see we had a pretty solid day on Friday, just panning back. We have had quite a reasonable decline, but not as dramatic as we quite often get during periods of financial panic. And the Small Ordinaries Index is really been outperforming the larger stocks quite nicely at this stage, so that's quite promising. So that's it as far as the general update goes and the overall strategy, and we'll see you next weekend. Cheers.